Good afternoon, everyone. Thanks for joining us for our Small Cap Tech Conference. Hoping to do a few more of these in the future. We feel that Canadian small cap tech is not getting a lot of attention, so we'd like to increase that exposure via some online conferences. I'm Deborah Honig. With me, I have Victoria Rutherford and also Mathieu Martin, who kindly has offered to provide a keynote session for us to kick things off. As always, this session will contain forward-looking statements. If you'd like to know more about those, you can find them on the company's presentations on their respective websites. And there will be Q&A, so feel free to enter your questions in the Q&A box at the bottom, or you can send them to Vic or I. With that out of the way, Mathieu, I'll turn it over to you.
Thanks, Deborah. Thanks, Victoria, for having me. I'm very excited to be here, and thanks to everyone for tuning in. As Deborah said, my name is Mathieu Martin. I'm the portfolio manager of the Rivemont MicroCap Fund and also author of the Stocks and Stones Substack newsletter. Managing the Rivemont MicroCap Fund is my main occupation, my full-time occupation right now. It's a small fund. We're based in Montreal. We only have 8 million of assets under management, which allows us to play in the really, really small microcap companies. So our strategy is to find the most undiscovered and most promising growth opportunities in Canada. And typically we can find them when they're very early stage, very small, because we have low level of assets under management. So that allows us to be liquid even in the really small names. Just before we start, quick disclaimer that this presentation is for informational purposes only. Nothing I will say today is investment advice or recommendations. So I decided to title my presentation Death of Microcaps with a question mark, and question mark because that's what we'll try to find out. So we'll just start with an overview of what happened in recent years in Canadian microcaps. So first of all, if we look at the chart for the TSX Venture Index, you can see it declined a lot over the last few years. The index peaked in February of 2021 and experienced more than 50% drawdown, bottoming in November of last year. And as you can see on the right-hand side of the chart, it's starting to rebound a little bit, although it's very early stage in this recovery so far. Now, if we look at the trading and financing data on the TSX Venture specifically, all the data I will compare to the peak year in 2021, so 2 years ago. So if we look at the data for last year compared to 2 years ago, there are two different pieces of data that I typically look at. The first one is the equity capital raised in dollars. So that's the total amount of financing that is happening for TSX Venture listed companies. And that capital raised was down 60% last year compared to 2 years ago, and was also 30% below the long-term 15-year average. Then the second piece of data is the value traded. So it's essentially the trading volume, but in dollar terms. And that was down 72% last year compared to 2 years ago, and 41% below the 15-year average. So as you can see, both pieces of data are way lower than their historical averages. And it's challenging for both issuers and investors. For the companies that are publicly listed, it's hard to raise capital. And typically, these are companies that need to raise capital. They're in growth mode. And for investors as well, since the trading volume is depressed, it's hard to get in and out of these stocks. So on both fronts, it's been a really challenging market for companies and investors last year. Now, if we look at the year-to-date data, the same two data points for the first quarter of 2024, again, it's down year over year, 23% and 25%. So 2023 was a really bad year, and so far 2024 is even worse. So in aggregate, it's getting worse, not better so far in this year. If we just look a little bit at the US market, I've been comparing the large caps and small caps, large caps being the Russell 1000 index, and small caps being the Russell 2000. And as you can see on this table, the large caps have outperformed for 9 of the last 10 years, including the 7 last consecutive years in a row. So you know it's really a large cap show right now, and small caps are really left for dead. So in a sense, the market sentiment is extremely pessimistic right now towards small and micro caps. It's been very challenging, and we're left to wonder if there's a light at the end of the tunnel. But in my opinion, there is hope. So we'll see why I think there is hope in the market right now. So first of all, several microcaps have been acquired lately. These are some of the logos of some of the main transactions that happened. I'm sure many of you will be familiar with some of these names, if not most of the names. Now, if we look at the M&A data in aggregate, I put this table together. This is an overview of 15 recent transactions in the Canadian microcap space. These are all non-resource companies. It happened in the last 9 months or so. And I listed all the important data: premium, the transaction value, the type of acquirer, and the valuation. So we won't dive into all these specific transactions. If you're interested in that data, it's available on my Substack. If you look up the post "Flurry of Acquisitions Part 2," that's the post where you have this table with my analysis on it. But if we just look in aggregate, the average premium paid was 63%. The average transaction value was about 200 million. And a private equity firm was a buyer in 9 out of 15 transactions. So private equity firms have been very active in the Canadian microcap space lately, and especially US private equity firms. So US private equity firms have been especially active in the technology sector. 5 of the 15 transactions from the previous slide were in the technology space, and they were all acquired by US private equity firms. And one of the hypotheses that I'm making after doing the analysis, one thing I noticed that's been very interesting to me is actually the last column on the right, the percentage of revenues from the US. These 5 companies all had a very high percentage of revenues coming from the US. So even though they were Canadian companies headquartered in Canada, some of them reported their revenues in Canadian dollars, but they were essentially US companies. They were selling a lot to the US. And I think US private equity firms like that because they know the end market well. It's the US market. And so I think that's part of the reason why these PE firms have been acquiring here, especially also with the foreign exchange rate that's been very attractive for US buyers coming to Canada. Now, if we look at some of the metrics, you can see that the growth rate on average was about 12%, so not necessarily super high growth. And it shows that you don't need explosive growth to be an acquisition target for private equity. And in terms of valuations, these companies were all valued based on annual recurring revenues, and the average multiple was 3.7 times. One other thing to note is the correlation between the valuation and the growth rate. So the lower the growth rate, the lower the valuation. The higher the growth rate, the higher the valuation. So that can give you a rough idea if you're looking at a microcap opportunity currently in the technology sector. Based on their growth rate, you can kind of extrapolate what kind of multiple of AR it could be worth. Although obviously it depends based on other characteristics like gross margins, customer retention rates, and things like that. Now let's just look a bit at the dynamics in the private equity market to try to understand why PE firms have been acquiring Canadian companies. So on this chart, this is a chart from Visual Capitalist. It was published late last year, and there are 2 lines on the chart. The green line is the private equity dry powder. So that's essentially the amount of cash that's on the sideline, the cash that's been committed to PE funds that's not deployed yet. And the orange line is the M&A deal value. So as you can see, there's a strong correlation between dry powder and M&A value. The more cash there's on the sideline, the more it gets deployed and the more M&A transactions there are over time. But this correlation has not held true in the last couple of years. And I think there are a couple of reasons for that. I think the main one is the rise in interest rates. As I'm sure people know, PE firms typically use a lot of leverage. They use a lot of debt to make these acquisitions, and the rise in interest rates have made it more challenging to finance those deals. And also maybe the macro environment has been a little more uncertain lately. So I think that's why PE firms have kind of refrained for now from doing very large deals, and instead they've turned to smaller opportunities. So I think that would explain why they've been looking at the Canadian microcap space with an average transaction value of about 200 million in the last 9 months or so. So what should we look for next? How do we position the portfolio at this point? This is only my opinion, but what I look for, first of all, strong fundamentals. I think right now it's safer to invest in companies that don't need to raise capital. As I showed before, the financing environment has been very challenging for microcap companies. That's not to say that no financings are happening. There are, but typically the terms tend to be more favorable to the new investors compared to the existing shareholders. So I for the most part, I try to stick to companies that are profitable, or if they're not profitable, that have a very solid balance sheet and a long cash runway. Then in terms of financial metrics, I'm personally looking for 20% revenue growth or more, but I think 10 to 15% at least is attractive, especially if they're cheap. So for tech companies with the software as a service business model, you can value these companies typically based on AR. So if you can find them for less than 2 times AR, and there are a lot of those opportunities right now in the market, I think that's very attractive, especially when you consider that PE firms have been acquiring in the 3 to 4 times multiple range. So that gives you potential upside of 50 to 100% if they get acquired in the short term. And if they don't, I think paying this kind of valuation for a growing company is going to do well in the public markets over time as well. And then for other industries outside the tech sector, companies that are profitable tend to be valued on PE ratios or EV to EBITDA. And the comparable transactions from the previous table show that these companies have sold for anywhere from 13 to 19 times EBITDA. So if you're paying less than 10 times, it's probably a good deal right now. And finally, in terms of sector and geography, well, to me, tech looks really attractive right now. I'm seeing a lot of opportunities, even with the we had a little bit of a rally in the last few months, but still I'm finding a lot of opportunities below 2 times AR. And if they have a high proportion of revenues coming from the US, to me that's a bonus. It means that they're more likely to be an acquisition target in the short term as well. So I just wanted to share a few reasons to be bullish on the Canadian microcap market right now. The first is that the fundamentals are strong. We're talking about microcaps here. These are early stage companies for the most part. I'm not saying that all companies are doing well. That's not the case, but the companies that were doing well before the bear market are still doing well for the most part. So I don't see any fundamental reason why these stocks should be down 50% like the TSX Venture Index. The companies that were executing are still executing. The inflation and supply chain issues are mostly behind us now. and companies are reporting strong financials. So that gets me comfortable investing in the space right now. The second thing is that the trading volume is picking up in some pockets of the market. As I showed on the previous slide, trading volume is down year to date, but this is anecdotal. This is based on my own experience, but I'm seeing more liquidity in two pockets of the market. The first one is what I call the larger opportunities, which is, to me, is 100 to 300 million market cap companies. These are the types of opportunities that typically are more on the radar of institutional investors. Maybe they have a few analysts from the investment banks covering them. And when the institutional capital is looking to come back to the microcap market, they typically enter the space through these kind of larger opportunities that are a bit more well-discovered and a bit more liquid. So these names, I've seen an increase in liquidity lately. And the second bucket is just what I call quality companies. So they can be smaller than 100 million market cap, but if they're growing and they're profitable and they're reporting strong earnings, these stocks have started to move and move on decent volume as well. So I would kind of focus on these two buckets at this point before moving on to perhaps more speculative stuff in the coming years. And then the third point is that stocks are making sustained moves following good news, which is something we hadn't really seen in the last couple of years. Companies would report strong results and nobody cared. But now it seems like people are starting to care a little bit more. I've seen companies report strong financial results and the stock moves 20, 30, 40% in a day. So I think that's a very encouraging sign. And even though we've had a little bit of a rally lately in some quality microcap stocks, I think the valuations are still really low in historical terms and also compared to large caps right now, way disconnected from large cap valuations at this point. So I think there's a lot of runway for multiple expansion over the coming years as well. So my conclusion is that Canadian microcaps are not dead. I think it's a great time to own them, to invest in the space. And I'm going to leave you with this question. Who would like to be a contrarian at this point and invest in an asset class that's been really overlooked? So if you want to learn more, the topics from my presentations, those are topics I covered in my newsletter. It's a free Substack newsletter called Stocks and Stones. I encourage you to subscribe. I'm also active on social media, mainly LinkedIn and X. I share every month the trading volume and financing data as it comes out from the TMX group. I share that on social media. I also share the acquisitions as they happen, and I write one article per week for the newsletter. And just one last point on the newsletter, it's called Stocks and Stones. Stocks because I talk about microcap stocks, and stones because I share some of my trail running adventures. I started doing ultra trail races a few years ago. Some say I'm crazy to do that, but I'm training for a 110-kilometer race this summer in July. So I share a bit about those adventures as well. It's a small part of the content, but I'm sharing mostly how I try to develop grit, resilience, perseverance, and I think those skills are very useful as a microcap investor as well. So if that sounds appealing to you, I encourage you to subscribe and follow me, and I look forward to connecting with many of you after the presentation.
Thanks, Mathieu. Appreciate the presentation. I would encourage anyone listening to sign up for the newsletter. It's really good. I read it every week. So yeah, thanks, Mathieu. I guess I have one question for you. What do you find more punishing, being an ultra marathon runner or a small cap investor for the past 3 years?
It's a tough one to answer, actually. Being a microcap investor has been really, really tough. I've been investing in this space for about 10 years, and definitely it's been the toughest 2 or 3 years that I've experienced. So yeah, it's a good question, Deborah.
One other question for you. So you spoke about what you're seeing in terms of like broader themes in small cap. Are there any like more specific themes that you're looking at, like investment themes that you're following in the tech space?
Not specifically. I mean, I'm a generalist investor, so I'll just try to go where I can find the most value. I typically don't tend to, I mean, I'm a bottom-up stock picker, so I'm just trying to find the best opportunities regardless of the sector or the team. Of course, if there's a tailwind or a strong team behind the company, that's even better. And typically you get multi-baggers by having that strong team behind a company that's executing. But it's more case by case. I don't have any specific thesis, like macro thesis right now about the sector in particular.
I had a question, Mathieu. I was just wondering, within the space, are there certain revenue models that you prefer when you're looking at different companies?
Yeah, well, I think I spoke a lot about technology. So the software as a service model, I think is very attractive. And I mean, it's no secret. I think generally investors are probably aware that this is attractive because you get recurring revenue. So it's predictable. It's typically high margin. And also, I think maybe one aspect that sometimes maybe overlooked by investors is the ability for these companies to operate with negative working capital. So if they charge for a 1-year subscription upfront, the client pays upfront, and then the service gets delivered over time. So when you look at the financials of these companies, the revenues are actually a lagging indicator because the cash has already been received upfront, and then the expenses are paid. The revenues and expenses are recognized over the course of the coming year. So these companies can operate with a large deferred revenue balance in the liabilities and essentially a negative working capital. So that's very attractive for these companies to be able to access non-interest bearing financing like that.
And then in general, like you talked about how it's been difficult in terms of equity financings. So how are the balance sheets of a lot of these companies? And you just talked about being able to operate with deferred revenue. Are a lot of these companies in the microcap tech space able to grow right now, I guess, given what's going on for their financial statements and their balance sheet?
Yeah, well, again, it's more case by case, but I think another beauty of the SaaS business model is that companies can scale back on expenses fairly easily. So I think we've seen a push to get to profitability for a lot of microcap companies that weren't profitable, and then they realize, oh, we can't really raise financing right now, so let's just push to get to profitability and sustain ourselves without having to rely on the market. So overall, I would say it's not been too bad. Obviously, like the smaller opportunities with lower revenues that don't have enough scale to reach profitability in the short term, those companies have been struggling more and more.
I guess my last question, since we have time, if your thesis doesn't work out, do you think like valuations are at a floor? Like, what's the downside from here?
Yeah, well, it's hard to see any downside. I mean, there's always potential downside. We never know what the market will do, but I would say I was more worried in the early part of 2023 when the market was just in free fall and we didn't know where it would bottom out. But since the acquisition started by private equity firms in the middle of last year, I think that's kind of put a floor on valuations at this point. And one interesting thing I can mention, when companies get acquired, and these were all cash offers. Shareholders of these companies get an infusion of capital, and they typically redeploy it in other opportunities that are similar. So if you get a lot of tech companies getting acquired, well, investors will redeploy that capital into other similar tech opportunities. So that kind of creates buying pressure for these other stocks that are remaining public. It's just like more money chasing fewer opportunities. So I think that's why we've seen an improvement in liquidity lately and kind of a floor on valuations at this point.
I don't have any other questions, Vic.
No, I'm good. Thanks, Mathieu, so much.
Yeah, thanks, Mathieu, for presenting to us today. Always great to see you. And I think you're doing some presentations next week at Planet MicroCap in Vegas. So looking forward to seeing you there.
Yeah, exactly. I'll be in Vegas next week. So if anybody's there, feel free to reach out. I'd love to connect with you. And thanks Adelaide, thanks Deborah and Victoria for having me. It was a pleasure to be here.
It was a pleasure to have you.